bringing on board Nilesh Shah, MD/CEO at Envision Capital, joining us this morning. Nilesh, let me start with the bigger question. What are your overweights at this point of time? What is it that you're liking? Let's start with that.
Well, in terms of liking, lots really out there to kind of see and evaluate and
Heartening to hear, by the way.
Yeah, because I clearly believe that, the Indian economy and the Indian investment environment is changing and changing quite dramatically. Several new frontiers are opening up, which weren't really kind of around, not too long ago. And you're clearly seeing huge amount of opportunities. I mean, be it around manufacturing of components which go into semicon, data centers, energy, automotive, aerospace, defense. That's a very, very interesting kind of an opportunity out there. And you're clearly seeing many of the businesses make the most out of that. And especially the ones which are catering to global OEMs, part of global supply chain, they are net exporters, are going to win disproportionately in the times ahead. So that's one big area. The second big area are businesses around consumer credit, capital markets, which are leveraging technology, which are leveraging digitization, which is clearly underway, and are making themselves relevant to the Gen Z and the aspirational consumers in India. And that's a very large kind of a segment, almost about 400 million consumers out there. So that's the second big area, which I clearly believe it's a huge pocket. And the third is to do with around pharma, healthcare. That's again one important. So I clearly see many of these businesses, and I would call them as the new frontiers, which are clearly emerging, and that's what makes India so exciting.
Nilesh, you've been a bull for digital payments, and you mentioned about it. What is the growth that you see in this particular? Is it going to be disproportionate, or is it going to be a sustained growth and a long-term theme for you?
It is. I mean, clearly, digital payments is honestly India's best showcase from a global standpoint. UPI has truly been path-breaking, truly been seminal. And the kind of opportunities it creates is phenomenal. It's helping our entire economy to formalize and financialize in a much significant way. So to that extent, I think we have just basically gone on to the initial stage where we have been able to bring in a lot of people who use digital payments for their day-to-day transacting. Yeah. So I think that's there, and that's obviously there's still some way to go before we can say that we are fully saturated out there. So I think there's going to be, for the next few years, there's still going to be a growth runway. But what's going to be very, very, I think, interesting is that how do you then leverage...
Monetize it.
Yes, and then you monetize it by reaching out to these consumers, payment platforms reaching out to these consumers and offering them products around credit, around insurance, around capital markets, investments, savings, and then even transacting. That I think is quite phenomenal. And so if you look at economies like China, for example, and players like Alibaba out there have basically been able to create an integrated e-commerce and payments ecosystem. I think in the next few years, we will see some player in India to emerge and be able to offer a very, very comprehensive suite of offerings for the millennials and the Gen Zs.
And do you see in that some of the private sector banks taking the lead or the public sector banks taking the lead?
I don't think it's going to be either.
It's going to be fintechs.
It's going to be fintechs because the banks typically do not have the kind of DNA to be able to relate to this emerging aspirational set of consumers and users in India. If they could do it, they would have done it by now. Okay, it's been what now? It's been 10 years since the UPI got introduced. We've just kind of celebrated the first decade of UPI, and look at it where the banks are. They will at best be kind of a support infrastructure because ultimately you will need a bank for your transactions to pass through. But beyond that, the ability to reach out, I think is something which is lacking. And I clearly believe that in the world of digital technology, it's always going to be the new set of players and not the legacy players who will establish a right to win. And that to me, I think is very, very important.
You know, one of the key things which is coming into the payments ecosystem is the CKYC. Consolidated one KYC for entire financial products, whether it's banks, capital markets, or any other thing. Do you think that would, you know, create a multiplier effect if people are able to, use it in a proper way?
So eKYC is only a starting point.
CKYC.
CKYC, it's only a starting point. It helps you in onboarding a client.
Yeah.
Okay.
But currently it is separate for every aspect.
Fair enough. Doesn't matter. It's not that the others can't do it. I think as far as whenever there's technology available and you can do it, you can do it. More importantly is how do you create the user experience? I think that's way more important. And to that extent, I clearly believe that the fintechs have an edge versus essentially the conventional legacy players.
But Nilesh, I totally buy into your argument. The only question, therefore, is what price you pay for the business that you're buying, right? And for the moment, just the way valuations are, do you believe that fairly valued, a good time to probably enter? Maybe, I understand this may be a decadal theme, or should you wait and probably wait for a dip to come in?
So first of all, this is going to be basically, this space is for the patient investors.
Right.
This is really not for someone who's really looking at the short term, because yes, some of them have performed really well as basically from a stock price perspective. Obviously, that's backed up by very strong fundamental business performance. But it's meant for really the long-term investors. So if you clearly have a 3-year, 5-year, 7-year view, is then when you should really be in these segments. Because I still believe that it's still probably 8 in the morning for them from a business point of view. And it's still a very, very long journey. And these businesses, be assured, are not going to remain the way you see them today. Be rest assured that in the next 3, 5, 7 years, many of them will further transform and look very differently. Because these are businesses driven by founders who are ambitious, they're aspirational, they're agile. And that's what really matters in today's world. And that to me is the differentiation, the softer aspects, the DNA, I think is a huge differentiator which they have versus any established legacy firm.
How do you align that with the market expectation then? Because founders have high risk and long view.
Look at it. Markets have honestly no expectations. Look at many of these stocks. They look good that they have done very well from the last 3 months, 6 months, this thing. But majority of them, many of them have not even been able to get to their listing highs, which they had in 21, 22. Okay. So to that extent, yes, from the last 1 year and all that, they can look very good. But if you look at it over the last 4, 5 years, they haven't got, because market, I still believe is grappling in terms of how you evaluate them. What's the kind of value you assign to them? And therefore, what's the kind of price that you need to pay for them? So I still believe that it's very early days, both in terms of the business cycle, as well as from an investor's point of view.
And Nilesh, again, I'll try to get to another crucial point. Is it a winner-take-all kind of a game? Or is this going to be multiple players? Because very often what we've seen, even among the listed pack, and this is not just one example, right? The top player is trading at a significant premium to the number 2 as well. So should you go out and buy the number 2? Is that the better way to play value?
Honestly, no. It is winner takes it all. Jo jeeta wahi Sikandar.
Got it.
Okay, it's that. Don't honestly deploy your hard-earned capital towards the number 2, number 3 players, unless of course they have the ability to become a number 1, and you are able to really spot that. But it's hard because the number 1 player then gets very deeply entrenched, builds a moat, and tries to protect his turf in the best possible way. And this is essentially the new age world where you become, you kind of race to be the number 1, and then you hold on to that position. That to me I think is key, and because there are so many pockets that you really don't need to waste your time, effort, energy trying to look at that number 2, number 3, number 10.
Sure.
And you look at all, now we have a few of the public market, in the public markets. You look at insurance distribution, you look at payments, you look at basically stock broking, okay? You look at quick commerce, food delivery, many of these segments, and you clearly see the difference between that number one and the others which are listed out there. Stark difference. And the market basically is saying is that winner takes it all.
But every decade has disruptors that come in. And they disrupt the top rung company of that sector. How do you identify that disruptor?
So first of all, I don't even know whether it's true only for a decade.
Every
I think
decade
once
has some set of companies which do that.
No, but not necessarily in the same sector. I mean, you clearly see companies which, HDFC Bank IPO'd in 95 and at least till 2020 kind of held sway, right, for 25 years.
After that, nothing.
Yeah, but 25 years, where are we? We've just completed barely 5 years. Most of our new age companies started their IPOs in 21 and are still IPOing.
Yeah.
Okay. So I honestly don't think it's, like what I said, it's still 8 in the morning and surely not 8 in the night. So I still believe that they still have many, many years, if not many decades, of a growth opportunity. Number one. Number two, where's the ownership? Are they really, how many of them still belong to the Nifty? It's only when out of 50 companies, you have at least 10, 15, 20 companies which are really from the new age, then you would actually say that yes, now this space is coming off age. It's becoming part of the large cap indices. So far, of the 50 companies in the Nifty, of the Nifty 50, there's only one company which is you could call as a new age company. The rest 49 are not those. And keep in mind, it's not just the new age. I mean, the opportunities are beyond, digital platforms using digital technology in pockets like credit, capital markets, consumption are just one side of it. In addition to that, there's so much of opportunity in manufacturing. Manufacturing is still sub 20% of our GDP. That's a number which is going to go phenomenally high, and especially with all the policy initiatives and reforms undertaken over the last decade, all of this will manifest over the next decade or two. That's really when you will see multi-billion-dollar companies around manufacturing emerge. How many unicorns do we hear in that space? So these are really some exciting hotspots which I believe investors need to focus on.
What within manufacturing, Nilesh?
I think, Harsh, it's still going to be companies which are actually making either components or subsystems. We have just a handful on the system side on the defense. But I still believe that the big opportunity for the next 5, 10, 15, 20 years are small, nimble companies which are very efficient in their operations and in their capital utilization and can extend their capabilities from one segment to many other segments. So it could just be a small automotive company, but is now beginning to look at defense, is beginning to look at aerospace, is beginning to look at semiconductors, data centers, all of that, or basically smart grids, smart meters, all of that. So companies which can cater to that ecosystem, I believe have essentially still a long way to go.
And you're very good at this. So how do you differentiate between a company which is pivoting, which will actually successfully pivot versus not? Is there a characteristic that one can identify?
No, I clearly think one is to first of all be convinced about the current capabilities.
Right.
Okay, and then is to really look at what's the kind of opportunity set or the adjacency that this business is looking out for, and why do we believe that it has a right to win in the next set of opportunities. So it's like, yes, a company can be great in the automotive space, but from automotive, what is it trying to do? Is it trying to do provide components, manufacture components which go into aerospace, go into defense, go into semiconductors? Where is something we need to figure out, and why do we believe that what it is trying to do, it has a fair chance of success? I think that's really the kind of area, and I think those with very differentiated precision engineering capabilities will be the winners. And what do their clients look out for? Their clients look out for essentially design capabilities, manufacturing capabilities, an obsession for quality, an obsession for delivery timelines. Once in your existing space, you have been dealing with global OEMs. It could be an automotive company which is dealing with global OEMs. Once you've been able to demonstrate with them and have been having relationship for the last 5, 10, 15, 20 years, you essentially, I think, pretty much have a good head start to kind of look at some of these other adjacencies and emerging opportunities.
You also look IT very closely, and this is one of the pain points for many of the street as well. How do you see the IT companies moving from here on? Do you see the sell-off on IT is now over and it's like a time consolidation for them at this point in time?
Sajid, you asked a very pertinent question, right? Because you said, how do they move on from here? The big question is whether they move on or are they going to move back?
Yeah.
Because so far the business model has been around hiring, thousands and maybe a few 100,000 engineers and essentially bagging those kind of contracts, multi-year contracts. That's really been the mainstay, which has basically been a mainstay for the last 3 decades.
Yeah.
And obviously, AI, agentic tools have clearly been some kind of I wouldn't say a black swan, but it's a bit of a disruptor for their existing business models. And I think the next few quarters, one will have to be on a wait and watch mode. I think there's already been a reset as far as the
valuation
markets go.
Yeah.
The markets have basically kind of now reset their valuations, and they now trade like as if bonds were getting traded. They come across more as fixed income opportunities. So it's going to be wait and watch. It's a transition. It's a pivot. It's a transformation, which probably they will have to undertake. And that's going to be very, very different. The future for them is going to be very different. And it's not easy for them to kind of be able to pivot from this, hiring a very large number. And that was their mainstay, that look, I have thousands of people whom I can deploy on a project, and your project will be accomplished. Those thousands of people now look to be replaced by a set of agentic tools. Some of them will be able to create platforms of agentic tools which they can offer to their enterprise customers. But it's a pivot which is not going to happen overnight. It's going to take some time. There's going to be challenges of repricing. Pricing earlier was driven more by the number of people that you are deploying on a project, the number of man hours. From there, is moving more towards outcome based. Now, whether a large IT services companies has a hybrid model, which is partly where there's some project driven, which is more man hours driven. There's going to be some work which is going to be more driven by agentic tools. And outcome-based pricing is all something on which I don't think today we have binary answers. So let's see, let's wait, let's watch for another quarter or two. Let's see whether there is basically deceleration of growth or whether there is basically deflation of pricing or there is basically an ultimate disruption. That's something which we all as investors will have to keep looking out for and assessing. But today, I don't think there's a very straightforward, simple answer.
So, from a market's point of view, the valuations have corrected, and you yourself said many of them are dividend yield plays at this point in time. How long should you wait? Should you position yourself in your portfolio, given that now the valuations have bottomed out, and now it's a wait and watch game of how they pivot, or as you said, either they modify themselves to the new age or they perish, basically?
I think probably one should wait for that first, basically, sign, of inflection. I think one should wait. It doesn't matter if stock prices run up a bit before that, but because the valuations are so attractive, you will have enough time. I don't think right now it just makes sense to basically preempt that there's going to be basically some kind of a growth path in the next 2 or 3 quarters. I mean, if after 2 quarters one assesses that yes, growth is back, then after that you can still kind of get in. It doesn't mind whether you pay from, instead of 13p, you end up paying 15 or 16p on trailing earnings. I don't think it's going to matter a lot.
And what will be that green node that you will be looking out for them?
No, I think ultimately it's growth. How are you getting your growth? And growth in revenues, not growth in bottom line. Growth in earnings, you can still engineer by laying off people, not hiring people, and you're going to save on salaries, you're going to save on costs, right? And therefore there can be margin expansion. The other thing is, the other headwind which IT companies have is the currency. The currency is depreciated, so that's going to be essentially an added icing on the cake for the next 2 or 3 quarters. So I think margin expansion, margins holding on is good as long as revenues do not decelerate or degrow.
Nilesh, again, just trying to play devil's advocate or trying to understand this better, right? These companies have very large cash pools. They're clean on corporate governance, and generally what they say is generally what's written in stone, right? And third is that, and therefore they have the power to acquire if at all things were to get nasty for them, if I can call it that. Do you therefore believe that the risk reward is low of a complete disruption happening? Is the risk of that very low?
So they have been acquisitive for a long period of time.
That's
even
true.
within the last 10 days, there have been announcements of acquisitions, and even over the last 10 years. So they have been acquisitive in pursuit of inorganic growth because they have clearly seen the writing on the wall. Saying is that this conventional model has probably run its course. So how do we essentially acquire other businesses which give us the skill sets or give us customers or give us access to some geography? So that's really been the playbook for almost now a decade or maybe even longer. So it's not that they haven't done this. The question is that it's not really helped them materially so far.
Sure.
Okay, if you look at, say, the last 10 years growth for many of the large IT services companies, the growth has been single digit in dollar terms. Okay, so this has really been a single digit growth story. And that's why if you see over even 10 years, they have really not been the huge market outperformers that they were expected to be 10 years ago. So to that extent, I'm not too sure how much of acquisitions will help. I think it's going to be still a reorientation. Okay. The way, for example, some of the digital tech companies in India pretty much kind of disrupted or impacted the growth of many of the other companies. I think similarly in the world of IT services, you're going to see a bunch of smaller, nimble companies who will create smaller pools of people who will use agentic tools to deliver solutions, and they are the ones which will basically deliver much, much stronger growth. I'm not yet sure if one can see any of them on the horizon right now, but that's really the space to watch out for.
Fair point. And how do you therefore play AI? From an Indian investor lens, right? How are you playing AI? Because you catch trends early, and this is obviously a very clear trend. How do you play it?
So if you look at AI, I mean, there are 3 or 4 layers. There's basically the foundational layer or the model layer where somebody's creating LLMs. I don't think from a public markets perspective there are any. There is 1 or 2 like Sarvam who are there, but they are still private. So that's really not much yet to play, but one needs to watch out for the space. The second is basically what you would call as the infrastructure layer, which is basically companies which are creating the data centers. The third essentially are the picks and the shovels, where you basically bet on companies which are going to be providing energy or providing components which go into creating energy capacity and things of that kind. And there are a whole bunch of them, whether you play on smart grid companies, you play on wires, cables, that's really the segment. And finally is the application layer. I think from India is a great application market. And any of the companies which can create some smart applications based on AI to help to acquire customers, to provide them user experience, to solve their problems, to improve their processes, to help product discovery, to kind of create those search engines. I think those are really going to be the winners of tomorrow. And that's really the big space to watch out for.
And who will the biggest winners among the traditional businesses be? Will it be the financials, the banks?
I think it's going to be the combination of financials and consumer internet platforms.
Got it.
And then to some extent, some of the D2C companies, the direct-to-consumer companies. I think these 3 would probably be the biggest beneficiaries because A, they will be able to improve their internal processes, improve productivity, but also gain market access. I think that really will be the big set of winners there.
Nilesh, you spoke about D2C companies. What we've seen is that they're able to come and disrupt a micro market, but not able to scale up and eventually get acquired by an FMCG company or others. Where do you see this? Because if you're betting on them, the scale up is the biggest issue for them.
So I think, Sajid, yes, that's pertinent, but basically companies, once they get to about 300, 400, 500 crores of revenue, after that they find it difficult to scale up. And therefore, the kind of acquisitions that we have seen over the last year or 2 have been those kind of companies, which have got acquired by the big players. But once companies cross the 500 crores of revenue for a brand, after that, I don't think they have had any challenges in terms of growth. And we've seen the emergence of a couple of companies. So we own a couple of companies like, say, Honasa, which has very successfully scaled up Mamaearth. It's scaling up very successfully Dermaco. And a few more are essentially in their stable, which have the potential to scale up. So it's not that nobody's been able to scale up. I think like real life, the bunch of those winners or the Sikandars will just be a handful and not all of them. So that's really happening. You look at, say, for example, again, we own another company called Nykaa. And the house of Nykaa was what they have created, which is their bunch of own brands. There also, if you look at it, a couple of their brands are scaling up and scaling up quite meaningfully. So I think one needs to really focus on those kind of companies. So in the public markets, there are enough options, or at least there are a handful of options where you can see some of these companies being very successful as D2C players who are growing and are scaling and winning at scale.
And the biggest challenge which many of them face, and which Nykaa may have, Nykaa and Honasa may have, overcome, is the distribution network, right? I mean, it's a painful process of moving that, because there's a strong moat which is there of existing players who don't allow that to happen. Do you think that that would be the biggest challenge for any D2C brand to move towards that?
That's actually a challenge for legacy players. So if you really look at the big legacy players, what were their moats? Their moats was a pan-India distribution network of millions of kirana shops, number one. Number two, with the strength of their balance sheet, they could basically go and buy prime slots on televisions and pretty much capture, so to that extent restrict anybody else's entry into that space. So that was the second big moat which they had. Both these moats have basically got impacted or disrupted or diminished. Okay. Whereas versus that, the newer set of companies have been able to create alternative moats around essentially the digital platforms, social media platforms, influencer-led marketing. Forget influencer-led marketing. Founders themselves are becoming influencers, and they're basically being able to connect to their consumers and converting their consumers into communities. That's what we are really seeing, and that's something which is very difficult for some of the old age companies, the legacy companies, to be able to do that. Can you imagine the CEO of a multi-billion-dollar company coming overnight out there and saying if there's a consumer problem, he's out there to address it? No, it doesn't happen, right? And the new age consumers are looking at some of these things. So they're looking at the medium, they're looking at the content, and they're looking at the commitment on the part of some of these newer firms to be able to essentially do business with them. And I think that's made a huge difference. And it's like we said earlier when we were talking about financials, payments, and can legacy firms do it? I think that's a serious handicap which legacy firms have.
Okay. Nilesh, thank you so much for coming in. Always
Pleasure.
Wonderful speaking, because,
Thank you.
Because you get a very different lens as to how to think, and think in decades rather than think about tactical buys, right?
So, quarters to years and decades.
Thank you so much.
No, wonderful having you. Wonderful conversation as well. Viewers, I hope you've enjoyed it as much as we have. What we'll do is slip into a very short break, come back with more. Stay with us. Plenty to speak about. We'll have Juniper Green come on the other side, because they came out with their numbers earlier, day before yesterday. And we'll have a conversation with the management on what's in store. Stay with us.